Hello traders. Every beginner is taught support and resistance. I was taught the same strategy too when I started, but the truth is, those levels are just symptoms of a deeper cause, which is supply and demand. In this video, we will expose the difference and reveal which one can actually give you consistency when it comes to results. Without wasting much time, let's dive right in. As I said, many traders rely on support and resistance, and the reason is simple. This is the easiest way that you are taught out there on how to trade. Look, someone tells you what you need to do. Open your charts, look for the first touch, second touch, and then the third touch, enter. If it was touching something around here, you enter either to buy or to sell. Very simple and quick. Others focus on supply and demand. And then we shall go to supply and demand and see actually what is this animal called supply and what this other animal that is called demand. Today we will explore all this and their differences. So we are going to see how they are connected to each other, why one goes deeper than the other, and we shall see which one is stronger. Is it support and resistance or supply and demand? With reasons, of course. And we are going also to get to understand how to use them both for better trades. Let us look at support and resistance first. What is support? Support, it is this level, the floor where buyers stepped in. How do you identify that floor? It is simple. You just need to find the touches whereby the price reacted from towards the upper side. This price was coming down, it touched this level, went up, came down again, touched this level, went up. Simple. Mark it as your support, okay? But is it gonna hold in the future? We don't know, but you can see what happened here, okay? This other level above here, price went up, it was rejected, came down. This price went up again to this level, which is close to this. It got some rejection, came down. And then we see price going up again to this level. It is rejected again. What do we call this? We call this resistance. Why do we call it? It will act as a ceiling, whereby once price is going to bounce from this floor to that ceiling, is going to be rejected and bounce off to the floor again before it gets bounced back up to the another ceiling. So that is how the support and resistance forms on the chart. And actually, this is the most simple strategy. Seems to be clear, and it is the most popular. And the reason why it is the most popular, it is easier to spot these bounces, and anyone can do it. But the question is, does it work? We shall find it out. We are going to also see the weaknesses of support and resistance before we go to supply and demand. So, what are some of the weaknesses of this support and resistance? First of all, when you are relying on the touches, look, this was a touch, this was a touch. So, do you call this resistance? I don't know. If you call this resistance, what do you call it when it is now supporting here? So you see, this is where the confusion comes in. You really do not know where to call what. Because if you call this resistance when it was rejecting this price towards the downside, it has turned to be support on this other side, and here it has been pierced through. So does it still hold or it doesn't? This is where the confusion is. Secondly, there's another level up here. This level, we see price is consolidating. Price tried to come down, it was not able to come to this level. This level supported it. So the level around this acted as support to support this price. When it was coming down, it never came all the way to this floor. It got some support, bounced off up, and then came. At the time it touched here, it went up. It has formed another resistance. Now the question is, will this resistance hold? And if it is going to hold, for how long is it going to hold? Because look, we've got the first touch, we call this the second touch. This is the third touch. Then if we are supposed to enter, what if we entered at this level, when we saw this bearish move, what if we entered, the price would have just turned against us and take us out. As simple as that. Okay, look at this scenario here. This level has been pierced again. The price came and violated the move. When it violated the move, it got that support below here, and then this, if we call this the first touch, we call this the second touch, and maybe this is the third touch. Okay, we are looking to see that engulfing, bullish engulfing candle. Did it happen? It happened at some point here, which was a bit late. Okay, if we entered, we entered. If we missed, we missed. Okay, but now look, so you are going to sit at the chart a whole day trying to monitor how candles are going to form at a particular zone for you to find an entry. Sounds easy, but it's very tiresome exercise. Okay? Price often weaks through support and resistance. As we have seen, we saw this level rejected. When it got here, it was rejected back. We thought maybe when it is coming here for the third time, we are going to find our selling opportunity. But what happened? We entered maybe after we saw this movement down, we entered, and what happened thereafter? We were taken out aggressively. Why? We shall delve into the reason why this price did not respect this zone later on. Number 3, it doesn't explain why price reacted. Because now look, this was just a random level. The price came up, it got rejected here, went down. This other one came up, got rejected, went down. So now if you're trying to find a reason as to why this price is being rejected at that zone, is there any logical reason? So we are trying to find a reasonable cause of this rejection. You cannot find any. You're just working on assumptions. Just maybe this price is going to reject again when it is going to tap into this level. But what backing do you have behind your decision making? There is no logical reason behind it. It is pure guesswork. That is the best definition of support and resistance. It thrives on hope, but that just maybe price is going to react from this zone and give us a sell or a buy signal. Okay, then it doesn't explain why. I have said that many traders watch the same levels. What does that mean? If everybody else is watching the same level, that is liquidity pool that is building. Look at this zone. The first touch was here. The second touch was here. It went up. It came a little bit. It gave you a touch. And then look at this. This was a beautiful bullish engulfing candle. So for those who wanted to enter, probably they said, okay, we have seen the first rejection. This was the second rejection. And at this third rejection, we have seen this beautiful bullish engulfing candle. And they entered at this zone. And then they put their stop loss somewhere below here. And then they targeted their 1 to 2. But what happened? Immediately you press enter. The price starts working against you. Then it took you out. Okay, you say, okay, I was wrong this time round. I'm going to wait for another touch. So you find, okay, this touch is touching here. Again, you start counting. First touch, second touch, fourth touch. I don't know how many touch you want to count before you enter again. Okay, but it is not the best way to do that, because everybody else knows that level. People are going to jump in aggressively. And most likely, those who are going to trade this way, they're newbies. The experienced traders don't do this. But for those who have been hired by brokers and some prop firms, they will teach you the easiest way to put your money where they will come for it. Because look, if a broker hires me to teach you how to trade, do you think I will teach you how to make money out of my broker? The answer is no. I will teach you the easiest way, the way that you will find it simple to make money, but it is the easiest way that you are going to lose the money to the broker so that they can be able to pay me. Because at the end, if they have hired me, it means they must pay me. And if they pay me, they cannot pay me to help you get money from their side. They must pay me to lure you into the trading traps so that you lose your money. Then I go for my paycheck by the end of the month. Supply and demand. What is demand zone? The demand zone, this is where the institutions placed their buying orders. Supply zone, this is where institutions sold from. And how do you tell that institutions have sold from a particular zone? You will see the imbalance, the type of pressure that is exerted. Because retail traders cannot move this market from this all the way down here, because they do not have all the lot sizes to do that. But now the institutions, the hedge funds and all that, they have the money to put on the lot size that they want to move that price down this way. So we want to identify the source where these guys entered, and this source is here. So when the price is traveling back to the supply zone, what do we want to do as retail traders? We want to enter with them because we have seen their footprints. Now we are not going to start counting the number of touches, because you can count this as the first touch, the second touch, the fourth touch, and then you want to call this, I don't know, your resistance. But now, trading with clarity, you want to find the footprints of these big boys, and you can clearly tell they entered here because the price started dropping. And when the price came back to that level that they sold from, you can see what happens. The price dropped down to this level, and we're going to ask ourselves, which level is this that is rejecting price? You will see when there was consolidation around this zone, we had very huge candles printing up very fast. When this candle printed up, it came down. The reason why this price was forming all these touches, it is because this is a breaker block. A breaker block, it was the last candle that could have held as our supply, because when price came up, it got rejected at this point, and then it dropped. When it dropped this way, this one, we mark it as our supply. But when now it is violated, it turns to be demand. So this was a demand zone, because it was a supply that has turned to be demand. That is why it held to go up. But why are we again going to mark another demand below it? We are marking demand below it because this is the source of the move that violated the supply that was above it. So this is the main source. This is where the big boys entered from. So we mark it as our demand. Look at what happened. When price left the supply zone, it came down all the way to this level. And what happened? It went all the way back. Once it touched the supply zone, the very first touch, the reaction was there. Came down to this level. When it came down to this level, what did it find? There was demand. How do we tell it is demand? There was consolidation, and there was some bit of consolidation, and then we saw a very impulsive move away. This impulsive will tell you big boys had entered the market. Your 0.1 lot size cannot print this huge candle. It means thousands of lot sizes have made that possible. And who can enter with all those lot size? These are the big boys, the money makers. Therefore, we want to trade within their footprints. This is why this is going to hold better than the support thing you're going to work with. Why traders miss out with only support and resistance. So when you want to mark your levels, you want to start counting the number of touches that level is going to be touched before you qualify that zone to be your resistance or to be your support. But what if I told you by the time you're counting the first touch, the second touch, and the third touch, you are already late? Because look, this is our supply zone, okay? And you as a support and resistance trader, you are waiting to count first touch here, the second touch here, and maybe you want to enter at the third touch. Then this is now the time you want to see this bearish engulfing candle before you jump right in. But for that person who knew that this was the source of this movement, I am only waiting for the very first touch. Once I see that price has come back to my supply zone, I'm going to find my break of structure, I'm going to find my change of character, and then the supply that is going to be formed here, and I enter. Look at how the supply and demand has worked out. You do not have to wait for 1,000 touches before you enter. Just one visitation is enough for you to pull a trigger. That way, you are not going to miss out. For that person waiting to see 3 touches, they are already late. You've made money using supply and demand at this point. The resistant guy is waiting to see this touch, but you who is doing supply and demand, you know when the second touch comes, it is another opportunity for you to short, because you know very well these big boys entered their orders here, and when we got the first touch, it means some orders were filled. The second touch, it means some orders are gonna be filled again. When you find the third touch again, you're going to enter. So you have entered 3 times when the support and resistant guy is going to try their first attempt. But for you who is doing supply and demand, you've entered 3 times. So the third time is when this guy who has now qualified this level to be resistance is trying to enter. And probably they might have waited for the third touch, and maybe the fourth touch is when they wanted to enter, just maybe. And look what happened. When they entered, immediately they were taken out. But for you, because you marked this entire level at supply, you want to see some reasons you want to jump in. So probably you marked this as your break of structure, you've marked this as your change of character. So you are waiting now to jump in. But for the resistant guy, they have been taken out already because their stop loss was somewhere around here. They saw this first touch, second touch, and third touch. Now they want to enter, and what is happening to them? They're being taken out. I believe you are seeing now the reasoning behind using supply and demand and using support and resistance. Secondly, this thing is the real reason why price moves. Price is not going to move from a position just because it wants to form a level. No. Price is going to react from a zone simply because there are a number of orders resting at that particular point. Those are the only reasons that make the price move. For instance, when this price left here, it came all the way down here to this level. This was a demand zone, because look at this, there was very impulsive move up. So this level, there was demand. This tells you there were resting orders. So when this price came down to this level, the resting orders were filled, that fueled the price up. When this price came down again, those orders that remained were filled for the second time. So for you, it means supply and demand. You traded the first touch, you went with the price up. You waited for the second touch, you entered the market again, you traded up. For this other guy has just marked this level as their support. They are waiting now for this level. So by the time they are entering, the demand guys have eaten twice as much as they are going to try to eat for the first time. And again, look, they are going to wait until they see this huge bullish engulfing candle to form for them to say, okay, now this is a perfect support level. But for you, because you know this is demand, you just put your limit order at your demand. Every time price touches it, it triggers you in, you go up. Touches it, triggers you in, you go up. Touches it, because you know this is the real cause of the market movement. You do not really want to depend on the number of touches. You want to use some level of guesswork accompanied by luck for you to make something out of the market. It is going to be stressful, my friend. Okay. Also, institutions control the movement. These institutions, you can see how aggressive the candles move from this place. So it means institutions placed their orders at that particular point. That is where we find supply and demand. we are going to see the key differences, the aspect, and then now we will break them down, and then you see the reasoning or the logical reason behind it. Basis. When you want to look for support and resistance, it is used on the past reaction. But for supply and demand, it is institutional orders. Form, it is horizontal line. This one is a zone. You don't care about how many touches you're going to see on the price. If you cannot see your zone around the level you want to trade from, then that is not your zone. You don't trade from that area. Reliability. Support and resistance often breaks, but this one is strong, especially when fresh. If I take you back, you can see. If someone marked this level as their support, so how many times has it broken? It broke here, went down. Okay, they said, okay, look at this. It never even touched the level. It never touched the level. And by the time it is touching, it is breaking the level again. Look at this. It is coming, breaking the level. But when it comes to supply, this level here did not break even an inch. It is still intact. Still intact. That is the key difference between the two. Accuracy. Support and resistance, it is retail forecast. That is where liquidity is. And then remember what I told you guys. Most people who teach this way of trading, they're hired by brokers. They want to teach you on how to put your stop loss where the broker is coming to sweep it, so that they can find their paycheck by the end of the month. So be cautious to who you are listening to, because they could be making you their liquidity in the market. But supply and demand, it is institutional driven. It does not matter what your broker wants to do. If you know how to trade this supply and demand, these levels are going to be respected. Okay? So whether your broker likes it or not, you're going to make money out of the market. What happens when supply and demand aligns with support and resistance? Then that tells you it is going to be smoking. Why? Because the level where we have seen numerous touches tells you there is liquidity. So once you see liquidity, because you know, newbies have been told, look, when you see this touch and this touch and this touch and all those touches, look to enter from these zones and put your stop loss somewhere below that. But for you who is listening to this, I believe you're going to trade better. Therefore, how do you utilize the support? You use the support level as a level of your liquidity, and you find demand sitting behind it. Once you find that, then it means you can place your limit orders. When the price is coming down to that level, the orders are going to be activated, and you aim the next zone, because you know the price is not going to stop at any level here to give you any touches. It is going to go straight to the next liquidity. This is the next liquidity, because when it left here, it came down. This swing is liquidity. It got swept out and you pocketed your money at your take profit. Okay. Supply and demand is equals to where smart money is acting. And support and resistance is where retail is watching. So the retail guys are watching this, but the smart money are acting from this zone. That's the difference. If both overlap, then it is a high probability, like this one. We can call it an overlapping, because you see what is happening. That tells you there's a lot of probability for this zone to hold. If you are serious about mastering supply and demand trading, go ahead and hit that subscribe button. Smash that like button also, and share your thoughts in the comments below. I read every single comment of you, and that informs me on what I bring next. Therefore, do me that one favor: subscribe, comment, and share it with the person you feel want to learn as you. Thank you for watching this far, and remember to trade where the institutions trade from. Trust supply and demand, but use support and resistance as your confluence to place that limit order. Bye bye for now. See you in the next one.